Hey, everyone.
Hello.
Hello. Hey, Mark, good to see you.
Hey.
So Albert is the one that's in the logged in as KW Salt Lake City. So he's my assistant, and he just got his license. Yeah.
Thank you. Thank you.
We'll just give everybody a couple of minutes here, and then we'll go ahead and get started. Realtor standard time and all. Jen, what's new in your world?
What's new in my world? I'm trying to get better at bookkeeping and accounting.
Ooh, that's a good one. I'm doing the same. Yeah.
Yeah, really focusing on it. Working with some high-level professionals, trying to be accountable. It's my words matter, so I'll be careful.
Somebody has a maps coach.
No, but I've been around enough high-level professionals to know that's true. It is something I haven't focused on much, and haven't really needed to. My whole professional career, things have been, pretty good financially.
Right.
But my approach has been sort of Wild West gunslinger,
Sure. Yep.
I'll make that money and pay off.
Everything will just be okay.
Yeah, I mean, for the most part, it has been.
Yeah.
But I've used credit to float cash flow, which has worked fine. But at some point, you look over at that pile of debt and go, "Oh no, this is not acceptable," right?
Right.
So yeah, so I'm trying to get better and stronger and smarter, in particular in that arena of my life.
Boy, I totally understand that. I've been trying to do the same thing. I just got a new accountant, and I'm now actually creating accounts in the chart of accounts, which feels scary, but I'm doing it. Because with flips especially, like I've really got to have a handle on that accounting side of things, because otherwise I'm going to pay more in taxes than I need to if I'm not tracking all those expenses. So I get it. Yeah, it's one of those things that for me is not natural, but that doesn't mean I can't be great at it. I just got to work at it.
Yep, absolutely. Yeah, it's a skill. It can be learned and developed, and
exactly,
it's an important one.
Absolutely. Hey, Randy, thanks for joining. So, Randy, you also just got your license, right?
I did.
That's great.
Very recently. I just finished my onboarding on Monday.
Congratulations. Yeah, I was just mentioning my assistant Albert is on here as well as KW Salt Lake City. He just got his license too. So cool. You guys can commemorate.
Yes.
Okay.
Congratulations, new licensees. You're in a good place.
Thank you.
And hey, that's Liz. Even though it says KW Salt Lake City, that's Liz. Welcome, Liz.
Sorry, it's me. I'm just doing my makeup really quick.
Hey, no problem. It's a little makeup tutorial.
I'll be right back.
Creative financing.
I'm gonna go blow dry my hair. I'll be right there.
Yeah, when you come back, Liz, I want it to be full drag makeup.
You know, I actually have gotten most of my tips from watching drag videos. I just go a lot lighter.
Yeah, your contouring's a little bit less severe.
Yeah. But I'm like, oh, that's how they get their cheekbones to look so good. Oh.
All right, well today, and we are recording, great. So today I thought what we talk about is some creative financing. We've talked about seller financing in the past. That's one aspect of creative financing. But I wanted to talk about a few others before I kind of dive in. And again, this is a mastermind, this is a round robin, like we're just here to chat. Is there anything in particular that you folks would like to talk about, or any deals you'd like to go over, or anything along those lines?
I do have a specific deal, but I think it's more seller finance. So if we want to wait till the end and if we have time, we can kind of.
Okay, we can talk about that. Sure, Mark. How about you?
I was just gonna say a buyer that maybe has bad credit or something like that. How do we work with them and get them in a better position?
Sure. Okay. So let's talk about that first. So how many people here have dealt with buyers that have poor credit and are struggling to get qualified for a loan? Yeah. So that's good. So that means all of us have different approaches. So so for me, there's a couple of things. I mean, typically the lenders I work with are working with them to get their credit up and trying to track that down. Really, when it comes to conventional lending, whether that's FHA or conventional VA, whatever, the credit has to be dealt with first before you can really get them qualified for anything. Some of the creative ways that I've seen it work, and I haven't mastered how to make money as a realtor doing this, but other ways that I know people can get into those are lease options are a really popular way. And essentially, like, you see that listed as rent to own. I mean, it's a little bit of a misnomer, but it's easier to understand. So with the lease option, you have two documents. You're signing a lease, just a traditional renter's lease for a certain amount of time. And then you are also signing an option agreement, and you put down a specific amount of money to have the option to buy that home in 1, 3, 5 years. Usually there's some kind of, term associated with it. And the idea being that during the time that you're leasing it, you are working on your credit in order to actually purchase it. So sometimes you'll agree on a price ahead of time. Sometimes it'll just be, whatever the appraisal comes back at. But that's one way people can do it. Liz or Jen, what have you guys experienced in terms of how you've helped your buyers that are having a hard time qualifying?
Well, so I shy away from lease options a little bit unless I represent the seller.
Got it. Makes sense.
Is weighted to the advantage of the seller.
Right.
I have seen it work for buyers. Actually, I did one where I represented both the buyer and seller. I would not do that again.
Oh, tell us why.
It's just not for me.
Got it. I.e., it's a nightmare.
Yeah. I have done dual agency on a regular transaction, and I don't find those particularly difficult.
Right.
But when you throw the seller finance element in there, I would not do that again to represent both sides. I was young and naive. It was a long time ago. And so, one thing that I've seen is that a price was agreed upon, and then, that the buyer was able to exercise their lease option, and the seller was hoping that they wouldn't.
Of course, yeah.
Right. And so when they did, and they did so at a significant profit.
Of course, yeah.
Right. And so that felt even more painful to the seller.
Because he felt like he had to sell, or she had to sell.
Right.
At a price that was lower than they could get. Yeah.
Right. Yeah. And they were contractually obligated.
Sure.
And so again, I don't have much experience. I have very little experience, but you know, I don't know. I tend to not, I'm not crazy about the lease option.
Yeah, and I agree with Jen in that lease options are really great for sellers in the sense that as I've talked to people that have done lease options, 90% or 95% of the people will pay that option fee and never exercise it. And so as investors, they love it because they're getting, you know, say $5,000 as an option fee or 10 grand, whatever. And then at the end of 2 years or 3 years, whatever the term is, like they don't do the option. And so like, then they'll, you know, wait and advertise it again and let somebody else. Now, I don't think there's anything moral about that. I mean, it's up to the buyer if they are going to be disciplined enough to actually be able to do it. I mean, they put the money down to do it, but many times, yeah, that doesn't happen. Liz, how about you?
So I have seen this work to the seller's advantage, and the seller was actually my mom, and it was to the buyer's advantage. And that's what's kind of, I've had a hard time wrapping my head around is there a way to structure it so that both sides can win? That's what I'm trying to get out of this.
Mm-hmm.
So my mom did one, you know, the value, I'm trying to remember. So this was before I was in real estate, you know, circa 2008, 2011, somewhere in that.
Right.
And she couldn't sell her property for even what she owed. She would have to take a huge loss. So she had found some tenants that lived there for a year and totally destroyed it. And then she got really lucky and found some really amazing tenants that took better care of it than she ever did. And then funny enough, this Real Salt Lake player approached her, and he needed to offload money somehow. And so he was it was this really weird deal where he could buy the property as he basically could continue paying it down. And he could always buy the property at any time for what was actually owed.
Oh my.
And that was it. But my mom could never come back and say, all she could say was no until the loan was paid off, basically.
Right.
So it got to the point she's like, well, yeah, it's great that I can take this tax benefit. She's like, but I'm never going to make money off of this
Exactly.
house.
Yeah.
And so that was what was kind of hard with that particular situation is it's like, well, and I was just like, how can you renegotiate this so that you can sell it for market value?
Right.
You know what I mean? So that's what I was trying to figure out because I'm running into the same thing right now where I have a friend of mine that owns a restaurant and his wife, well, not his wife, girlfriend, she's only been paid as a W-2 employee for like almost a year. And I think she's a citizen if I remember right, but she's not reporting any credit or anything like that. And so according to most traditional lenders, she's going to need like 2 years work history before she would get a loan. And so he was like, yeah, I don't know what we're going to do. We really want to buy this house. And it's his friend that's selling it. And his friend's an agent, but doesn't really produce. And so I'm like, there's got to be a way that you can structure this deal so that I'm like, obviously, if I'm helping him, I want to structure it so that it's going to be friendly for him so that he can get a better deal at the end.
Exactly. Yeah.
But then at the same time, I'm like, I want to, I'm have that win-win about me.
Yeah.
I want to make it so that like, hey, the seller doesn't get screwed. And also like in the event, because it is like I think it's like a $750,000 house, if I remember right. And so it's like in the event that the market is impacted, I don't want him being tied to paying more for it if he doesn't have to.
Right. Yeah. You know, the funny thing is with lease options, I think they're difficult to make sense for the seller when we're in an appreciating market. Unless like the option agreement very clearly states that an appraisal will be done at the time the option is exercised. And
I hate appraisals. I hate appraisals too.
Yeah, well.
Because it's like, I don't know. It's funny because I feel like sometimes sometimes the appraisal comes in way higher than what you would anticipate. And then sometimes it comes in way lower. And it's like, it's just like me or any of us running comps on a property.
Oh, absolutely.
Different numbers. And I hate that you're like, okay, we're going to have this mutual third party come back and tell us but I mean, I guess that's really the safest way to do it.
Yeah.
So, is there, stupid question, is there an option agreement on the MLS?
Ooh, I don't know. I've never looked for it.
Look.
Maybe. I mean, I know they have a seller financing addendum. They may have one for lease option. Do you know, Jen?
I think they used to. I don't know.
I'm going to look while we're on here, because that was my other question is like, where do you get these forms?
Right. Mark, I don't feel like we really answered your question, but I think it's like it comes down to the lender in the end if they're going to be
Oh,
convinced.
yeah, and that's honestly what I do. I've never done a seller finance or a lease option because I've never been in the business where the market made sense where a seller would actually agree to it. I've asked
Right.
sellers a lot, and they're like, no. So what I've done is I've partnered with a really great lender that really walks people through what they need to do and is really good at keeping in touch with them. And there's been several times where it's like, I've completely forgotten about these people. And a year or 3 years later, my lender comes back to me and says, oh, hey, so-and-so's ready. I'm like, who's that?
Yeah,
So
yeah.
that's honestly the best. Mine is Jordan Campana with Fairway Mortgage. I'll put his contact information in the chat box. It's gotten, I'm gonna just preface it with this. With the market being so crazy, he is not as diligent as he used to be.
Sure.
But he's still like, I think he does better than a lot of lenders. Like he at least will create a follow-up, and it just, you kind of have to team up with him a little bit more. Like I said before, it was like I could forget about somebody for a couple of years and they would boomerang right back to me. Now it's like I actually have to set some reminders and follow up with him and the client to make sure that they're still doing what they're supposed to. But he is the wizard of credit. He will make them get where they need to be.
Oh, that's great. Yeah, I actually bought a seller finance deal off the MLS 2 months ago, and I see like, so it's a win for me and it's a win for the seller. So this house, Alfred's actually helping me get it back to put it back together. It had no kitchen. They had torn it out. A bunch of drywall was missing. I think it was probably remediated for meth, and that's why that was going on, but not sure. And the bathroom was torn out. I mean, there was a broken toilet, and that was it. there's no tub. There's no vanity. So I purchased that for it's a 3-bedroom, 1-bath in Kearns. ARV is probably about 270. I purchased it for 230. I put 30,000 down, and then it's a 200K note, interest only for 3 years. So I'm only paying $1,000 a month for 3 years. It works for me because I can rent that and have some cash flow. It also and it works for the seller because she's actually getting $266,000 at the end of this transaction, because she owned the property outright, and so she's going to get an additional $36,000 a month for 3 years on top of the 230 that she paid. So she's happy because she feels like this was a junker property. There weren't a lot of people that could actually like take it over, and I'm happy about it because I've currently got soon to be 5 mortgages, and so as I go up in mortgages, the interest rates get worse, and so I'm trying to like buy as much stuff as I can seller finance just to help with that, right? Like, I mean, I split my mortgages with my husband, so we're shooting to get 20 total on both of our credits, but anytime I can take advantage of a seller fi, it makes a lot of sense for me to do.
What's the interest on that deal for you?
It is 5.5%.
Whoa.
Yeah, no, I mean, it's
On
not
the-
great, but it's seller fi, so.
Well, I think it is great for seller finance.
Yeah, I think that what they did is she wanted $1,000 a month, and so they just figured out what would the interest rate need to be for $1,000 a month. And I'm super happy to do it. So
Can I ask you a question about that, Alan?
of course.
Maybe this refers back to maybe the phone conversation that we had, but are those deals you're offering, the seller financing and that kind of thing, are you offering those to clients, or those are the ones you're saving for yourself?
Yeah, I've never sold, like I've never been a realtor on a seller finance deal. All the seller finance deals, I've done 3, and they were all deals I bought as just the buyer. Yeah, so usually in many cases, I mean, I did do one, I structured one seller finance deal for a flip I did this year, but the other 3 were all from a wholesaler. This one was from the MLS, but someone else had structured the deal,
Right.
and I just stepped in and said, yes, I agree to these terms. So
Cool.
yeah, I've never, and yeah, I think like in a declining market, being really savvy around seller financing in order to like save people that are underwater or something like that, that might make more sense, but I haven't been in that market yet. So it's never been a skill I've had to sharpen.
Cool. Okay.
Yeah.
Thanks.
Yeah. I think, so I bought another rental in Kearns, probably about, I don't know, Albert, was it like 2 weeks after, maybe 2 weeks after the other current. So I have two
I would say
current
so. Yeah.
properties. So, and this one I bought with hard money. It was a $230,000 purchase of a 6-bed, 2-bath in Kearns, my favorite city. And I put about 20 grand into it. And then we are in the process of getting it refinanced out of the hard money into a conventional mortgage. And the reason I do it that way is it's a lot easier to refinance a home you already own than it is to purchase a home. So like you don't have this 20% down requirement when you're refining it, right? You still have a 20% requirement, but if you strategically put the right repairs in, you'll get that 20%. And so Albert was actually there with me when I was waiting for the appraiser to show up, and we don't get the report back until Thursday, but I took comps with me. I laid them out on the counter. I never even like mentioned them. I let him find them on the counter, and he took pictures of each one. And he was so busy and stressed. He was like, so, and I was like, so do you think we can get like 310? He's like, so you think 310? And I was like, yeah, 310, I think. So I'm hoping that he's able to come back with that, because if that's the case, then I can refi without putting any money down. I should be able to, with that spread, I should be able to even cover like the closing costs of the refi in the refi itself. And so, so essentially that means I'll have a house that's now worth 310,000. I bought it for 230. I put in 10 or 20,000. So I'm only 250 into the house, and I just created 60K in equity. So that's another really interesting way to build up your rental portfolio. I mean, I'm all about rentals, right? Like all my flips are really just to buy more rentals. So
Tell me again, sorry, I missed
absolutely.
the beginning of that because I was looking for that purchase option. How do you get it so that you don't have to actually put the 20% down? Because you did something with hard money, right?
Yeah, so I bought it with hard money just like I would buy a flip.
Okay.
So, and I have a lender that will do 100% if the loan to ARV is low enough, and this one was. So knowing that I could get it for 310 once it was fixed up, and knowing it was only 230,000 to purchase, then the hard money lender was able to give me the full 230 to purchase. So I ended up paying like closing costs. I'm still about like 5K or something into that. Because when you're buying a wholesale, you're paying for both the buyer and the seller closing costs. That's the standard when you're buying a wholesale deal. So I'm probably 235 into it, but out of pocket, it was only the 20K in repairs and that 5K, so 25K. And what I have to work on is, okay, so it's 2 points. I think this was actually 2.5 points, but I have to figure out like, okay, it's 230 plus whatever my hard money cost is, and then that has to be 80% of the ARV. So to pay off the full hard money loan. I don't ever plan on getting, so I'm doing a rate and term refi, which is totally different than a cash out. A rate and term you can do anytime after you purchased a home, but you can't take out money. You can't take out more than, they'll reimburse you for like $2,000 as a max. So you can't take out any other money from that. But to me, it's like, that's great because I'm paying $2,300 a month in hard money. So if I'm, waiting for the hard month for like the 6 months so I can do a cash out, well, most of my equity got eaten up by that anyway. I wouldn't be able to take anything out. So I've done that quite a bit. I actually am getting my husband pre-approved so we can do it again this year. If I can find the right property that needs, I mean, I don't like putting more than 20,000, maybe 25 into it in order for it to be a rental, because I'm looking at it as, okay, so my full investment cash out of pocket is 25,000. And in the end, I'm creating 60,000 in equity. So like, like that cash on cash return is what I'm really focused on, because it's a long-term hold for me, which means like, I know appreciation will go up. I know that I'll get, I know I'll get all that stuff, but it's just, am I using the cash I have in order to, like, the best way possible?
I lost you. We can't hear you.
Oh, sorry, my phone rang and stupid people calling me. So where did you lose me?
So it's essentially that you were a wholesaler on the deal. So basically you were already showing up on the title and the loan because they had transferred it to you, and then you just refied it.
Right. I wasn't a wholesaler. I just bought the wholesale.
Yeah. That's
Right.
what I
Yeah.
was thinking.
And so, yeah, my name was already on title. And the important thing about that is that you have to keep it in your personal name when you do it that way, because
Okay.
it has to be your name, not like an LLC or anything like that. But this is how I handle it once I do the refi. So I always put my properties in a trust, and then the beneficiary of the trust is an LLC. And then my husband and I are the trustees. And so I do it that way because then it's still in the LLC's name. You know, it's still protected as far as asset liability and all that stuff in the LLC. But because it's a trust with one of our names on it, banks don't have any issue with it, right? Like you can put any property in a trust. Like banks know that. So that's usually how I hold them all. And so I just basically always do the address and then put family trust, because then it sounds more official. I mean, you can name a trust anything you want to name it. So I just like put family trust on there. So I also I went to a class, and I'm starting a new course on gap lending. And I wanted to talk about that a little bit because this is pure investor stuff, not necessarily realtor stuff, but as realtors, we're well positioned to do it. So gap funding is typically, it's a second position note. So here, I'll use my example for South Salt Lake because I think I've talked about it a few times. So I got the South Salt Lake house for $270,000. It was seller financed at 12% for 6 months. And then I got a second position repair loan from someone for $40,000 at 8%, no, 10%, I think. So that covered my closing costs and part of my repairs. What I learned is, well, like if I don't have $40,000, but I know someone that needs it, and I have access to other people that want to invest passively, I can actually structure a second position note so that let's say I borrow some money from someone at, they say they want an 8% return. And I say, great, give me, $35,000 and I'll give you an 8% return. And then at the same time, I put 5,000 of my own money in there. And then I go and find an investor that wants it and will take it for 2 points and 12%. So that is usually like the second position note, right? So $40,000 is given to an investor as a second position note. And the thing that's really cool about it is, as realtors, we have access to people that have money and want to invest in real estate, but maybe they can't invest as a full like landlord, like they don't have 20% down, but they do have, a good chunk of money. And if you put your own money into it, you're not brokering anything, right? Because you're just partnering with this person to make a loan. When the loan gets paid off, they pay 2 points and 12%. Well, you can do whatever you want with the points. You can keep the points, and then you keep the spread between the 8% that they are getting back as the main investor and the 12% that you're actually charging. So you end up making money on both points and on the spread between that. So it's a really good way to generate some more income. Like, I'm going kind of fast, but this is something that I just realized, and it's like, oh, we are so in a great position for this because we're talking about money with people all the time. People know that we are realtors. They know that we're experts in real estate. So it's a good way to start fostering like other income streams for yourself, so that you can then build up your reserves to do whatever you want with it, to purchase some more property or whatever. I went through that really fast because I've had a lot of coffee already. What questions can I answer about that?
So
I see a lot of furrowed brows. So.
When this deal comes to my lap, then I can call you. I mean,
Yeah, absolutely.
it makes sense. I guess my question would be like the actual documentation or contracts, or like where does that money sit, or how do I structure it? Because I understand the concept of, okay, keep the spread and the points. I guess it would be more like the actually how to do it, but that probably
I can talk about that a little bit.
probably comes with doing it.
Yeah. So anytime the great thing about doing something like this is it's collateralized against real estate, right? So it's on title. There's no confusion, right? Like, so it's a very safe investment because you're protected if the money doesn't get paid back. So it's just a note document. That is then recorded when you purchase the property, and it's a traditional note document that just goes through. Here's the interest rate. Here's the amount. This is like the payback terms. Here's the points. You know, all of that stuff, and then depending, you can either say to the investor, you need to pay me the interest monthly, or you can say you can pay me at the end. And if I was just starting out with an investor, I would always make them pay monthly because I want them to feel the pain of writing that. I want them to feel the pain of writing that check every month to keep them honest, right? So it's pretty straightforward. There's just a template that I got from like I went to a seller finance class, and my title company does a lot of these, and so they'll also write the note for me if I give them all the terms. That's actually what happened with my seller finance deal in South Salt Lake. Is they gave me the notes, and then I gave those to the people that were selling to me, so they had that on title. But yeah, that's usually how it goes. It's just, and then where the money sits is, so it's a loan. So you wire the money to title, just like any lender would wire money to title, and then it gets dispersed to the investor at the time of closing, right? So typically, like, they'll have a hard money loan that's first position. So let's say they're buying a house for $300,000, and then you've wired in $40,000. After when that transaction closed, both notes get recorded, and then the $40,000 goes to the flipper. And you can do some creative things, like you can hold back and make them do draws as well. You can say, like, you're only going to get 10,000 now, and once like drywall's done, then you can get another 10,000 or something along those lines. There's a lot of like control that you can have over that. And then once you've gotten to know them, I mean, this is great if we have flippers that are clients, right? And we want to, we've worked with them enough, we trust them, we've seen their work, like, maybe we're selling their houses. You can just kind of say, hey, like, if you need a repair loan, like, we can work this out, because it just engenders you to them even more, right? Like, it just makes you their realtor if, like, you've dealt with them on a lending perspective, because you're helping them win. They're gonna like want to work with you. The funny thing that I found is so many people have money if you just ask. So like I'm in a BNI group, and I went through 2 of my flips, and I had a presentation this last Tuesday, and I went through 2 of my flips, and like 5 people were like, I want to do a flip with you, Alan. And I was like, okay. So I don't typically partner on flips because I think it's risky. What I do is I let them lend money on the flip because I think it's a lot safer, and like they don't want to be that involved. They just want to make a decent return. So if we can agree upon what the fixed return is that they're getting, it's a pretty easy sell, because you essentially say, this is all recorded in title and you're going to get paid before I get anything. So like when the house sells, they pay off the first and second note, and then I get my money. So you're always going to get paid back. But a lot of people have like $30,000, $40,000, $50,000 in a bank account, in a stock account, like, that they kind of want to use for something, and they don't know what they're doing. So I've found that just mentioning the possibility, and it's kind of just like when you start being a realtor, and everybody that has been in the business for a year at least knows, like, that first year, all you're doing is convincing your friends and family that you're actually a realtor. Like, you're just like getting it so that they remember that you're a realtor. I think it's the same thing for anything when it comes to investment or lending. It's just about talking about it so that people know it's there, and then, like, when you have an opportunity, presenting it. That's one of the things that I'm going to be trying to do a little bit more. So my goals for flipping next year, this year I did 8, and I want to do 17 next year. So I need more money, access to money for that. Like, I can't bankroll that. So I'm putting together kind of an action plan to generate more interest around that, around like lending me money for flips. Oh yeah, Randy, I absolutely use a contractor. So I'm no good at it, which is, I think, lucky, because I never have even pretended that I was going to do the work. And so for me, that's nice, because it made me create systems so that I can do it. And so now I can just add contractors and keep the system going. And Albert has been a huge help in figuring out, like, how do we do that, right? So Justin Puchard did this month's education meeting, and a lot of what he talked about was being his own best client. I think as realtors, that's a really good point. So like, you know, I've done 8 flips, and of course I've sold 8 flips. And so if I can ramp that up, then like it feeds both my realtor business and my flipper business, because I always take a full commission on my flips. I don't feel like it's fair income if you're making money by not paying a realtor yourself. So I always pay myself the full 3% and the other agent 3%. What else do you guys want to chat about in terms of like, have you heard of other creative lending things that you want to chat about?
Can you talk to us about hard money lenders, like how do you who you want to work with? I know that there are several out there, but like, how are you vetting them? Is it all just referral and word of mouth, or like, what's your experience been in that regard?
Absolutely. So I have 2 main hard money lenders. Both of them were word of mouth. This is maybe content prior to investigation, but like big companies that are doing hard money are typically making a lot of money off of you. Most hard money lenders that I see that go to the RIAs or are like, you know, active in the investor community, they're just brokering their own money. Or like they've got some other people, but they're the ones that are doing it. So I like it when they are they're not a huge business, right? Because when they're not a huge business, you've got a lot more sway in terms of, hey, if you need an extension, like a lot of them will like work with you on that because they can see what's going on. Whereas I've heard horror stories of some of the larger hard money companies like lending on deals they know aren't going to work, and then like foreclosing on the house. Like I want to stay far clear of that, because to me, it's about like, I work with hard money lenders because they make money and I make money, right? Like, and it's a fair trade, right? Like, so the guys that I work with now, as I haven't hit a limit with those 2. So that's really why I haven't like branched out and looked for others, because every deal I found, they had money. And so I think I probably will need to start vetting more. Like I met another hard money lender last night at the RIA down in Sandy. I think that I've got to start, but like the questions that I ask are, how many loans do they have out right now? You know, because if like they don't have any loans, they're not a hard money lender. And then also like, what are their standard terms? So everyone's all over the place. My experience is like anything in real estate, it's relationships. So like your first deal with them might be 3 points and 12%. And then like the next one will be 2 points, or it might be 3 points and 15%. And then the next one will be 2 and 12, you know, like they've got to know that you perform. Once you've performed with them, man, they are like ready to go, right? Because I've worked with these hard money lenders. I've done so many deals with them. One of them actually just said to me, hey, as long as it's 65% ROI, you don't have to ask me, you've got the money. And I was like, whoa, feel like a big boy now. But that's really what it comes down to. It's like, how much have they done? Why are they doing it? You know, like, is this their main deal? Or are they doing this on the side? Like, I just like to ask a lot of those questions. And, you know, as realtors, we know how to read people. So it's also just like, do I feel like this person's legit? Like in what they're saying. And then the nice thing about working with word of mouth people is I'll just go out and ask. Like I'll ask some other people, like, what's your experience been, right? So that's probably the easiest way to go about doing it. It's also I think it's also worthwhile if they also do flips. So both of my hard money lenders also participate in flips. So they really understand like what we're talking about, and they'll push back in a good way if the deal doesn't look right. And that's a really valuable thing to have in a hard money lender, because, you know, if they're doing that, that means they're watching their money like closely, and they don't want you to fail either. So that'd be my best get. I mean, a lot of it's just pressing palms at the RIAs, you know, like just go into those meetings and introducing yourself. And like, you know, I went to the RIA last night, and when you sign the roster, they will send out the full roster of everyone that attended to the people on that list. And so I've actually got it printed in my office right now. And so like, I just go through and I get every single person that I don't know in that database. And I start like sending them emails, sending them bombs, sending them slide dials just to get to know who they are. Like, you never know, like either where a deal's coming from or where money could come from. And so a lot of it for me, it's just that, it's just always looking. Okay, Randy's asking, when you use other people's money, do you have the deal first and then reach out, or have the money and say, I'll let you know when I find the home? I typically have the deal first. So because to me, it's about like, I'll have a conversation with them and say like, you know, about how much money do you want to lend? Like, this is how I structure deals. This is the kind of return you can expect. You know, this is the length of the loan, but I don't like, I'm not taking anything until it's associated with an actual property. Because what I found is that when I reach out to people, not everybody has their money exactly at that moment, right? So like, even though they may want to do that, they may have done something else, and you know, it's not going to get back in time. So but yeah, one of the things I'm going to try and do this year with the help of Albert is like putting together like a standard email template of like a deal breakdown that I can just then send out to my second position lenders and say, this is an opportunity I have, you know, let me know if you're in a position to participate. Because it does two things. Like, one, it helps you find money, but two, it helps the people that don't have the money in that moment to remember that you find deals and that you send them out and that you're actively doing it. So I think that's a big part. I mean, I think that's what I'm really learning is so much of it is just staying top of mind, just like it talks about like in the Millionaire Real Estate Agent, right? Just staying top of mind with them, just subtly letting them know that you're doing this stuff so that when the opportunity comes up, like, they're going to remember that you do it. What else can I answer for you guys?
If no one else has anything, I wouldn't mind circling back to that one that I told you about.
Oh, seller 5? Okay.
I'm just wondering if it makes more sense that he does a lease option or a seller finance. Now,
Well, tell me what the situation is. You're on mute.
Sorry, I know I had to like take it officially off mute so I don't have to reach anywhere. Okay, so he is a restaurant owner, but it's his, and so his credit and income and taxes are messy. So
Sure.
he has been paying his girlfriend that's worked for him for like the last, well, they've been together for like 5 years. He's been paying her as like a regular W-2 employee for this year. So I'm led to believe, I think she's going to make, according to my lender, I think she's going to make just under 90,000. Let's call it 80,000 this year.
Sure.
And they want to
Okay.
be able to buy like a $650,000 to $750,000 home. With my lender though, she doesn't have enough work history, and I can't remember exactly what her citizenship is. But he was basically like, I don't think that I'm going to be able to get her approved until she at least files taxes, and it might even have to be one more year. And so they have a house that they like, and the seller is a friend and an agent that's willing to work with them. And so I don't know if it makes more sense to try to structure it as like a seller finance, or if it makes more sense to structure it as a lease option.
So I think the question I would have first is for the owner of the property. Do they still have a mortgage?
Yes.
On it. Okay. So then what if you did seller financing, then what it would be is called a wrap. And that means that you're wrapping an additional loan around the existing mortgage. So let's say, I'm just going to make up numbers, but let's say like, you know, the sale price of the house right now is $500,000 and the underlying mortgage is $300,000. So then like the way they could structure that is there's some kind of down payment. Let's say $50,000. And so that leaves $150,000 that's going to the seller of the home, and then the $300,000 that's going to the mortgage.
Okay, hold on. I'm writing this down. So
Yeah, no problem. No
sales
problem.
price 500,000, and they owe 300,000, down payment of 50,000. And then tell me, sorry.
Yeah, so there's 150,000 of that 500,000 that goes to the seller, right? And there's 300,000 that's going to the bank.
Okay.
So the way they can do it, if they want to, is then they can just basically set up a payment with a company like Escrow Specialists And essentially what they'll do is just make sure that both people get paid. So like the buyer will pay escrow specialist just like any other mortgage company, right? And then that company will send a payment on the $150,000 loan to the seller, and then the payment for the mortgage at the same time.
Okay.
Here's the thing that the owner of the home needs to feel comfortable with if he's going to do this. That mortgage is still in his name and it's still on his credit. And so like he has to make sure he feels comfortable with that, because like if that's going to affect his ability to buy another home, then that's kind of a big deal. Now what I have heard, and I'm not a lender, but what I've heard is that if you have sold a house on seller financing and the buyer has made payments for 12 consecutive months, then they can exclude that mortgage from the debt to income ratio. But you got to work with a really like investor savvy lender that's going to know how to do that, right? But I think that's the biggest thing. So if the seller wants to get some additional cash every month and is okay keeping that mortgage in place, then great. If they're not, then the lease option becomes a really viable thing, right? So like you can say, I mean, how long do you think it's going to be before the woman will be able to qualify for a mortgage?
So best case, I would say maybe 4 to 6 months. More realistically, it's probably going to be 1.5 to 2 years.
Yeah. So what I would do is I would do like a lease for 2 years and agree upon whatever that lease amount is, right? That has nothing to do with the mortgage, has nothing to do with the sale, they're just renting the house. And then identify what an option price would be for that property. And that option price is non-refundable, and it has nothing to do with the actual buying of the house. It's strictly to have the option to buy the house. And then within that, you would have to identify, well, how are we going to value this house? Because in 2 years, this house is not going to be worth what it is now, plus or minus, right? It's not going to be the same. So, in 2 years, when the option is executed, like, how do we agree on what the sales price is going to be? And you can do a couple of things. I mean, you could say like, hey, it is to be fair market value, but not less than $500,000. You can structure like that condition on whatever, because it's a contract, right? You can just agree on, this is how I want this to happen, and if both parties sign, then they're both contractually obligated to do it in that way.
What do you see for like a typical option fee?
I've seen anywhere from, it depends on the property. I mean, I've seen anywhere from 5 to 10,000, but I've seen like 25,000 before, depending on.
Because it's a pretty nice house on a golf course.
Yeah, and so that's the thing. Like, he has to feel like it's worth his time if he's going to do that, right? Jen, do you have any experience with option fees in terms of like what a traditional sellers typically charge? No, you're on mute.
Hey, sorry about that. I had a call come in. Did you ask me about option fees?
Well, yeah. So we were just kind of walking through Liz's seller finance potential, whether lease option or seller finance. And she just asked the question, is there, any kind of standard when it comes to option fee? And I just said, like, I've seen 5, I've seen 10, I've seen 25,000. And it really, like, it totally varies. Do you have any insight on that?
Well, they're usually round numbers. And,
right. Yeah.
And it's all negotiable.
Right.
And it sounds like to me, the difference between a seller finance and a lease option is like seller finance, the money is upfront and the money is always going towards the mortgage. Whereas a lease, it's like, it's an option. Like they don't necessarily have to buy it. And then
that's exactly
the money at the end is at the end.
Exactly. Yeah. So, and it's, well, so there's a little money up front because they pay the option fee right away.
Oh, they do pay, okay.
Fee, yeah, they pay the option fee right when they will move in, and that is non-refundable.
Right.
And so then it's just like he's a landlord for 2 years, right? Like nothing special about that. And then they have the option to exercise. Right now, they can just say, hey, I know I put down $10,000, but it's not going to work out. See you later. We're moving out, and that's fine. I mean, investors don't mind that at all because they just got an extra 5 or 10 grand for nothing, for just having a rental.
So it really sounds like seller finance is kind of a better way for the buyer to go.
For the buyer, yes. As long as the seller is open to having that on their credit.
Yeah. Well, and it's, I mean, with a lease option, he has it on his credit too. So it's,
Oh, absolutely. Yeah.
it's
Yeah.
really just like, it's hard because I feel the same way with Jen. Like I don't want to necessarily represent this seller in any way. I want to represent
Mhm.
this buyer, but I kind of want to have like a meeting of the minds, like have everybody meet at once and be like, here's the options. What do you
Mhm.
guys want to do? And kind of spin it in a way so that the seller finance deal looks better, because I know that's going to be better for.
Then you'll get your pay. Yeah, you'll get paid for it.
And I get paid.
Oh, okay. So one bit of experience is you want your option fee to cover your realtor fees,
Okay.
Ooh, good call. Yeah.
and you want to get your realtor fees up front if you
Okay.
can.
Now, what
Um,
realtor fees would that be? I mean, are you talking about like the 3% or really?
I
Okay,
don't know.
that's
Do you feel
really
like you
good
should
to know.
take a full 3 when like they've literally put the deal together and all you're doing is helping them with paperwork?
Why not? That's what we do.
True.
I mean, so the point is that everything is negotiable. So it
Right.
depends who you're representing, and that's why it becomes really difficult to represent both sides in a situation like this. Because if you're representing the buyer, you're going to want to have that fee as low as possible.
Right.
And if you're going to take some commission out of it up front, then, I don't know, I'm not an expert.
Well, and the thing is to thicken the plot for you is, so he wants to continue, he wants to keep picking up different sushi restaurants too. And
Mhm.
he wants me to help him on the commercial side. And I was like, yeah, no, I don't do that. And then I went to Shad and I was like, hey, this guy is like dead set on me helping him with some commercial stuff. And he's like, yeah, I think you're to the point in your career that you should totally start getting into some commercial. And I was like,
Oh, very cool.
okay. And so that's the other thing is it's like, I want this to be, I want it so that obviously like I'm getting paid, compensated for
Of
my,
course.
but at the same time,
Yes.
like I want to build this and say, hey, I'm going to get you this deal so that you're in house, so that then your credit for buying businesses later is even easier to do. So it's kind of like doing that first stepping stone. And again, like I'm all about like never discounting a commission, but also making sure that you're building that relationship right from the beginning.
Right.
Okay.
I think
When
it's
start
also-
structuring this, I'll probably have to ask you guys for some more.
Yeah, I'm happy to help. I think also one thing to remember is that when you buy a seller finance deal, that payment is not being reported to the credit bureaus.
Okay.
So like it's not going to build their credit if they buy something seller finance. It's going to be completely off their credit report,
Yeah.
which is, I mean, to me, that's why I like buying them, right? Is so that they're not on my credit report. They don't count against DTI. But if they're trying to build their credit, it's really important to understand that.
Yeah, that's, well, I mean, with a lease option, I guess you can use a lease to build credit.
Yeah. Yeah.
for special, okay. So it might not be a bad idea to run it past the lender and say, which one do you think would be better for them?
Mm-hmm. Yep.
And seller finance is the same way, where they're going to put money up front that's non-refundable, right? Or they don't necessarily have to. Maybe that's the other way I spin it, that it might be better for them.
Well, it's not that it's non-refundable. So the money they put up front, if it's a traditional seller finance deal, is they're putting a down payment on the mortgage.
And so if they
Right.
don't end up, oh, but they are, I mean, it is more like.
I mean, because there's no
they're not
approval,
sure to buy it.
right? Yeah, there's no approval. It's just like they put the money down. They've already agreed on the terms. They sign at a title company, but there's no lender involved in any way, right?
Yeah, okay.
Cool.
I
Anything
got
else?
to jump off.
Okay.
Alan, thank you. Liz,
course. Thank you, Jen.
Thank
AW
you.
Salt Lake City, thank you.
You got it.
All right. See you guys.
Bye, thanks, Alan, appreciate
Yep.
you.
Take care. Bye.
Bye.
Bye.